Next is revenue recognition concept. The concept of revenue recognition requires that the revenue for a business transaction should be included in the accounting records only when it is realized. Revenue is the gross inflow of cash arising from the sale of goods and services by an enterprise and used by others of the enterprise's resources, yielding interest, royalties, and dividends. Revenue is assumed to be realized when a legal right to receive it arises. The revenue recognition principle states that revenue should be recorded when it has been earned, not when the related cash is collected. That means the revenue is considered to have been realized when a transaction has been entered into and the obligation to receive the amount has been received. For example, an enterprise sells goods in February 2019 and receives the amount in April 2019. Revenue of these sales should be recognized in February 2019, that is, when the goods are sold. It is so because the legal obligation has been established in February 2019. Another example, suppose an enterprise has received an advance in February 2019 for the sales to be made in May 2019. Revenue shall be recognized in May 2019 upon sales have been made because the legal obligation to receive the amount has been established in May 2019. Thus, credit sales are treated as revenue on the day sales are made and not when money is received from the buyer. Next is dual aspect concept. Dual aspect is the foundation or basic principle of accounting. This concept states that every transaction has a dual or twofold effect and should therefore be recorded at two places. In other words, at least two accounts are involved in recording a transaction. The dual aspect concept indicates that each transaction made by a business needs to be recorded in two separate accounts. That is, every transaction entered into by an enterprise has two aspects: a debit and a credit of equal amount. Transactions are recorded in two places. For example, Mr. Mohan started business with rupees 1 lakh. Mr. Mohan started a business by contributing rupees 1 lakh as capital. There are two aspects to this transaction. First is cash of rupees 1 lakh and the next one is capital of rupees 1 lakh. The amount contributed by Mohan is rupees 1 lakh, which is an asset to the business organization. Cash invested by Mohan in business is an asset to the business organization. At the same time, rupees 1 lakh, that is the capital, is a liability to the business organization. Cash is an asset and capital is a liability. So, in this transaction, the two accounts involved are cash account and capital account. Thank you.